Hey folks, welcome back to the channel. This is Quant Street Daily Market Review, and this update is for the market session ending on May 12th. And let's look at how the market performed today. So it was a tough day for the markets today. You can see Dow Jones declining 2%, Nasdaq about 2.67%, and S&P about 2%. A lot of stocks in the declining trend today, whereas just about 462 of them on the advancing trend on the NYSE. Looking at the sector performance, so big decline seen in basic materials, consumer services, industrials, technology, utilities, healthcare and financials sustained a bit of this rout today. Let's take a look at the economic calendar and what sparked this kind of reaction in the markets. So today was the day for a CPI to be released. As you know, CPI is a measure of change of average price level for a fixed basket of goods and services purchased by the consumers. And looking at the CPI month on month, there was a positive 0.6% prior. Today it was 0.8%. Year on year it was 2.6, actual 4.2, while the expected was 3.6. So a considerable rise over the expectations that triggered this decline in the markets. And let's take a look at how it looks on the charts. So some of the important macroeconomic factors can be seen here. So the riser of today was the 10-year treasury, which is at now roughly at 1.69, almost at 1.7%, which is trying to touch the levels that were reached earlier in the year, leading to the market declines at that time as well. US oil index was almost flat, although energy stocks gained pretty well, and so did oil. That is again a multiplied effect due to the cyber attack on one of the major pipelines in the US East Coast. TLT and gold were also down by about 0.8%, and as I already told, S&P and Nasdaq, Russell declined furthermore, and you can see VIX jumping by 20%. Tesla, Bitcoin, Ethereum all declining by 3% by the time the market closed. But there has been a big news today, where let's take a quick look at that news. So Tesla to stop accepting Bitcoin for car payments, and that led to a very strong decline, as you can see here, about 13% down across all the crypto assets except this Dash and Ethereum, standing somewhat resilient to this sharp selling and lack of confidence after Tesla making that announcement. So let's go through some of the highlights. And as I already showed on the Vanguard dashboard, CPI shot up, and briefing.com key takeaway is that they are running hot indeed, but looking at the last 6 months only, which neutralizes some of the easy base effects comparisons, total CPI is running at an annualized pace of 5%, while core CPI is running at 3%. And the effect of this announcement on CPI led to, by 10:30, strong selling in the market. So as inflation concerns are circulating, with total CPI up 4.2% year on year in April and core CPI up 3%, these increases have been fueled by depressed base effects that took root in the early pandemic months. Yet it's worth noting that total CPI over the last 6 months, when base effects weren't so depressed, is running at an annualized rate of 5%. Almost a repeat of what was stated earlier, but this also led to Apple breaking below key support at 200-day moving average, whereas all the major tech stocks, Tesla, Amazon, especially in the consumer discretionary space, declined. The dollar climbed because cash likely drawing bulk of the safe haven flows today, as inflation worries hurt bonds and the ongoing weakness in the widely held stocks continue to hurt investor sentiment. Let's take a look at RBC's daily report. So most of it is has already been discussed about the CPI. You can see the 10-year treasury closing at 1.64, but right now it's at 1.69. The dollar index is at a key support level. So it's bouncing from a 90 level following the post non-farm payrolls sell-off. Let's take a look at what they think about CPI. So pricing pressure has been building as local and state economies have been reopening. Headline CPI advanced 4.2%, the largest advance since 2009. The resumption of travel has boosted prices of everything from gas to car rentals and hotels, although the jump is in large part due to the fact that prices have recovered after falling this time last year. So overall trend about or the sense about the jobs scenario. So small business optimism reached a 5-month high amid improving trends and better sales expectations. A record 44% of respondents said they have been unable to fill open positions. But I'll talk about a counter view from ABN AMRO shortly. The US job openings surged to a record high of 8.12 million in March. I'm not sure what job openings mean, where there are lots of jobs that are just lying open and they are not actually hiring. The businesses are not actually hiring, but just for the sake of having a job open, so that it presents a positive picture about the company. That's one reason why companies want to keep the jobs open. So I don't put a lot of weight into this job openings number. So let's take a look at what ABN AMRO is saying. So they are saying, for a sustained significant rise in inflation, the economy would need to overheat and remain hot for years and not months. Economic growth would need to be strong enough to create capacity constraints in the labor market, prolonged labor market tightness would lead to a sharp and sustained acceleration in wage growth, and companies faced with excessive demand for their products and services would need to have the pricing power to pass on higher labor costs to the consumers. Underpinning this process would be a jump in consumer and company long-term inflation expectations, which would encourage higher wages and price setting. So they say that they are positive about the blockbuster growth in the second half of the year, but it's likely it's going to slow down next year. And the labor markets is far away from being tight right now. The jobless rate is at around 9% compared to 4% before COVID shock. So even at low levels of unemployment, there wasn't much inflationary pressure. So their view aligns with what Fed has been saying, that expectation for inflation is to be transitory. So it seems that the markets are trying to overreact to an update about the rise in inflation, and it could be a good buying opportunity when it comes to some of the stocks and sectors that declined today. Taking a look at those sectors, so consumer discretionary, including Tesla and Amazon, minus 3.39. Consumer staples is minus 1.33, and the star of today was energy sector with a positive return. Financial also holding well, as did healthcare, whereas all the others were around 2 to 2.5%. Technology was 2.8% down. Let's quickly take a look at some of the subsectors. So airlines 3.62% down, disk drives 4%, hardware 4%, paper, semiconductors down also more than 4%. And you can see the gain in bonds. So these are the yields. So close 1.69 for the 10-year treasury note, rise of 3%. Commodities, gold is down, silver is down even more, and let's take a look at who were the gainers. So gasoline, crude, natural gas, so all the energy commodities up, and not sure what's going on with coffee over here, negative 7%. Cryptos doesn't show the real-time update that's happening right now with the latest update from Tesla declining to use Bitcoin for their cars. There is some uptick from the declines, the levels of 48,000 now, while we have been recording this. And finally, let's take a look at this dashboard, which compares various asset classes over the last 30 days. And you can see Bitcoin is negative, whereas Ethereum has just taken off, about 70% gain over the last 30 days. 6% down, Nasdaq, Russell about 4%, and SPY about 2%. The energy stocks, as I said, have been doing well, and today also they were positive. Base materials, financials, all the cyclical and inflation oriented stocks also positive. The star in among the commodities that I've been tracking on this dashboard is copper and the metals index. So TLT is down 2%, pretty big decline for bond market. So all over you can see, so over 30 days all the tech stocks have been negative, and Netflix, after its earnings shock, has been negative 12%. And yeah, I think that covers most of what I wanted to talk about, and with that I'll end this session, market commentary. Thanks again for tuning in. Appreciate your time and look forward to sharing more insights in the next video. Quant Street is signing off. The preceding content is informational only and is based on information available when created. It's not an offer or solicitation, nor is it legal or tax advice. It does not consider your financial circumstances and objectives and may not be suitable for you.